They say that lies have got 4 legs, but in this case they had 300. They were massive, complex, and most of all, extremely profitable. These were the biggest lies ever told to Wall Street. And the company that was behind them is today synonymous with corporate fraud and corruption, Enron. Hi, and welcome to this channel where we take you through the biggest, the best, and worst business stories ever. Today we'll look at how Enron rose to become one of America's most respected companies while hiding an accounting fraud of epic proportions. It's the story of how it lied to Wall Street for years, earning billions of dollars before eventually going bankrupt in one of the biggest corporate collapses in U.S. history. You'll find out what role Anderson played in this and why its CEO was sentenced to prison. How did traders make millions by betting against Enron, and how are such frauds even possible? The late 1990s were good times. The economy was booming, internet companies were multiplying like mushrooms after rain, and investors were making money hand over fist. This was the era when Enron's founder and CEO Kenneth Lay was weaving his web of deceit. To understand what he was up to, we need to first know a bit about him. Kenneth Lay wasn't your typical CEO. He didn't wear expensive suits or drive fancy cars. Instead, he wore casual clothes and drove a pickup truck. But don't be fooled by his down-home demeanor. He was a hardcore businessman who was never afraid to take risks. In fact, some of those risks bordered on the reckless side. Take, for example, his decision to enter the natural gas pipeline business. At the time, everybody thought it was crazy. It was a highly regulated industry with low profit margins. But Lee saw an opportunity. He started buying up pipelines left and right, including the one that would later bear his name. Within a few years, Enron had become the largest pipeline operator in the United States, and by the 1980s, it had gone global. But Lay wasn't done yet. He wanted more than just being a pipeline operator. He wanted to be a trader too. So he set his sights on the newly deregulated energy market. At the time, the energy market was still dominated by state-owned companies, but Lay was convinced that it would soon be opened up to competition. So he started lobbying the government hard. His efforts paid off in the early 1990s when Congress passed the Energy Policy Act. It opened up the energy markets to private companies and gave them the power to trade energy commodities. And guess who was ready for it? Enron. With its extensive pipeline network, Enron was in a prime position to capitalize on the new market. But it needed to raise a lot of money first. No problem, thought Lay. He went to Wall Street and sold Enron's story. Investors loved it. They threw billions of dollars at the company, which used it to expand its trading operations. By the late 1990s, Enron had become one of the largest energy companies in the world. Its stock price was soaring, and everyone from Wall Street analysts to investors to employees were making a fortune. But behind the scenes, things were not as rosy as they seemed. Enron was drowning in debt. It had taken on so much debt to fund its trading operations that it was now struggling to make ends meet. Lay tried to hide it from investors, but they saw through his charade. In 1997, Enron's stock price collapsed. Lay was forced to step down as CEO, and the company was on the brink of bankruptcy. But Lay had a plan. He knew that Enron's collapse would hurt a lot of people, including its employees, customers, and investors. So he decided to save the company. Or so he said. In reality, he was just trying to save himself. He struck a deal with the government to keep Enron out of bankruptcy court, but that came at a cost. The government wanted Lay to open up Enron's books to outside auditors. Lay agreed, but only partially. He allowed the auditors to examine only one part of Enron's business, its pipeline operations. He kept the other part, the high-risk trading operations, under wraps. The auditors found nothing wrong with the pipelines. They gave Enron a clean bill of health, and the company's stock price soared again. But it was all an illusion. Enron was still in terrible shape. Lay tried to keep the company afloat by selling more stock, but that too failed. On October 16, 2001, Enron filed for bankruptcy. The news sent shockwaves through the markets. Investors panicked and started dumping Enron stock. The price plummeted to just 25 cents a share. Thousands of jobs were lost and billions of dollars were wiped out. But amidst all the chaos, a few people made a fortune. They were the traders who had bet against Enron. One of them was Jim Chanos. He was a relatively unknown analyst at the time, but he saw something that others didn't see: the cracks in Enron's facade. In the early 2000s, he started shorting Enron stock. He borrowed shares from brokers and then sold them on the open market. If the stock price fell, he would buy back the shares at a lower price and pocket the difference. Chanos was right. Enron stock collapsed, and so did Chanos. Short sellers often get abused. They're called market makers because they're always betting on a stock price drop. But in this case, they were right. Their bet paid off, and they made a killing. But how did they do it? What made them so sure that Enron would collapse? The answer lies in the company's accounting. Enron was guilty of what's known as earnings management. Basically, it was manipulating its financial statements to make itself look more profitable than it actually was. Take, for example, its balance sheet. An asset is anything that the company owns, such as pipelines or trading positions. A liability is anything that the company owes to others, such as loans or accounts payable. Equity is the value of the company minus its liabilities. According to accounting rules, a company can only count something as an asset if it's probable that the item will produce economic benefits in the future. If it's not probable, then it's not an asset. It should be written off immediately. Enron flouted this rule. It counted doubtful items as assets and inflated its balance sheet. As a result, it showed a higher equity than it actually had. This made Enron look like a sound investment to Wall Street, but it was anything but. Take, for example, its off-balance sheet partnerships. These were partnerships that Enron created to hide its debts from investors. Here's how they worked. Enron would set up a partnership and then transfer some of its assets to it. This reduced Enron's assets and therefore its equity. But the partnership would then buy back these assets from Enron, which increased its own assets and therefore its equity. This made it look like Enron was more profitable than it actually was. But there was another trick up Enron's sleeve: mark-to-market accounting. Under this method, an asset's value is based on what it could be sold for on the open market, even if it's never actually sold. For example, if Enron bought a pipeline for $100 million but believed that it could sell it for $120 million, it would count the pipeline as an asset worth $120 million. This inflated its balance sheet and made it look like the company was worth more than it actually was. But it gets worse. Enron was also guilty of pro forma accounting. Simply put, it was manipulating its financial statements to make itself look better than it actually was. Take, for example, its income statement. An income statement shows a company's revenues, expenses, and profits over a period of time. According to accounting rules, a company can only count revenue if it's earned. That means the company must have delivered a product or service to its customer, and the customer must have paid for it. Expenses, on the other hand, can only be counted when they're incurred. That means the company must have used up some of its resources to generate revenue. Enron flouted these rules. It recognized revenue before it was earned and expenses before they were incurred. This distorted its income statement and made it look like the company was more profitable than it actually was. The real extent of Enron's fraud may never be known. The company destroyed billions of dollars worth of investor wealth. It left thousands of people without jobs, and it shook the markets to their core. And it all happened because a few executives were willing to bend the rules. And who enabled them? One of the biggest facilitators of Enron's fraud was its auditor, Arthur Andersen. The firm was supposed to be auditing Enron's financials, but instead it turned a blind eye to the company's tricks. Why? Well, we may never know for sure. But it's likely because Andersen was more interested in keeping Enron as a client than in uncovering its fraud. After all, Enron was one of Andersen's biggest clients. It paid the firm tens of millions of dollars every year to audit its financials. Andersen didn't want to risk losing that lucrative contract. In the end, Andersen was convicted of obstructing justice in the Enron scandal, Its CEO, Sam DiPiazza, went to prison for 2 years. How could such a large company go unnoticed for so long? Well, that's because Enron was really good at hiding its fraud. The company created a culture of secrecy. Its executives were rewarded for meeting earnings targets, no matter how they achieved them. This encouraged employees to bend the rules and hide the truth. Moreover, Enron's accounting was extremely complex. It used a variety of offshore entities and special-purpose entities to hide its debts. This made it very difficult for anyone, including its auditor, to uncover the fraud. So how did the fraud finally come to light? Well, that's because one of Enron's employees, Sharon Watkins, blew the whistle. She alerted CEO Kenneth Lay to the company's accounting tricks, but he ignored her. Watkins then went to the media, and that's when the fraud became public. What can we learn from the Enron scandal? Well, for starters, we can learn the importance of corporate governance. Enron's executives were more interested in making money than in telling the truth. This led to a culture of secrecy and ultimately to the company's downfall. We can also learn the importance of independent audits. Anderson was supposed to be auditing Enron's financials, but instead it turned a blind eye to the company's fraud. Finally, we can learn the importance of accounting transparency. Enron's accounting was so complex that it was impossible for anyone to understand it. This made it easy for the company to hide its fraud. Today, Enron is a cautionary tale of what can happen when a company puts profits ahead of the truth. Its collapse sent shockwaves through the markets, and it remains one of the biggest corporate scandals in history.